War dominates the news cycle, and the initial shock always triggers emotional selling. Experienced traders look past the immediate drama, recognizing that markets fear uncertainty more than the actual conflict. Once the direction of a war becomes clearer, capital flows return to established patterns, and we will walk through the exact steps to execute a highly protected, risk-managed trade. To get the most out of this, go ahead and open your live or demo trading platform right now so you can follow along with each step. Geopolitical volatility can erode capital for reactive traders. Preparing a structured, unemotional trading plan beforehand provides a framework for navigating extreme market swings. Step 1 is adjusting our mindset. Financial markets do not make moral judgments about global events. They operate on probabilities and profit margins. The historical data supports this. When the 2003 Iraq invasion began, the immediate reaction across global exchanges was aggressive panic selling. This chart tracks that initial market dip. You can see the steep drop here as uncertainty peaked in the early days of the conflict. But watch the recovery. As the direction of the war became clearer, strategic repositioning began. Within 12 months, the market rallied over 30%. Data from the 2022 Russia-Ukraine invasion shows an identical curve, a sharp initial sell-off, followed by a recovery as traders identified the specific sectors poised for growth. These initial dips are often temporary. Traders who prioritize historical data over emotional headlines position themselves according to long-term probabilities rather than temporary noise. Step 2 requires finding where the capital is actually going. Wars force massive, immediate shifts in government spending priorities, creating sector-based trading opportunities. The defense sector is the most direct recipient of this capital. Expanding military budgets flow directly to weapons manufacturers and contractors to increase industrial output. Energy markets also experience intense pressure. Tightening supply chains and prioritized strategic reserves historically drive up demand and profit margins for oil and gas companies. Finally, wartime pressure accelerates technological development. Modern conflicts rely heavily on cybersecurity, artificial intelligence, and semiconductor production, leading to major government contracts for tech firms. On your trading platform, open your stock screener now. Set your filters to isolate companies exclusively within these 3 resilient categories: defense, energy, and technology. A wartime portfolio must intentionally pivot away from standard consumer goods and align with these structural government necessities. Step 3 is following smart money. Institutional investors and hedge funds don't trade on news headlines. They position their capital based on contract data and spending patterns. To track this institutional money flow, you need to monitor 3 specific indicators. 1. Broad government spending patterns. 2. Newly awarded defense contracts. 3. Changes in national strategic priorities. Step 4 is a macroeconomic check. You must distinguish between a war-driven market dip and an underlying economic recession. Historical context helps. Conflicts like World War I and the Vietnam War coincided with severe pre-existing economic challenges already pulling the broader market down. Modern conflicts occurring far from major financial centers often have a more limited impact on global market trends. While local markets may be severely affected, international exchanges typically adapt to these new realities without sustained global disruption. Treating a localized geopolitical shock as a global recession leads to overly defensive positions that ignore the specific economic reality of the conflict. Now for Step 5, executing the trade. Go to your platform's search bar and locate a specific defense or cybersecurity index. Because wartime markets operate with elevated volatility, strict position sizing is a requirement. Whatever your standard trade position size is, intentionally cut it in half before executing the order. Next, we add the mandatory safety net for this strategy, the stop-loss order. Activating this stop-loss ensures your position automatically closes if the market moves against you. Setting this stop-loss protects your capital from sudden, unexpected geopolitical shifts. These strict parameters prioritize capital preservation during periods of high market unpredictability. You have now bypassed the headline noise, identified institutional trends, and executed a protected trade. Moving forward, continuously monitor government contracts as the conflict evolves. As trends clarify, dynamically adjust your stop losses to match the market's direction. Even when targeting these resilient sectors, maintaining broader diversification across different geographic regions and asset classes remains crucial to portfolio stability. It is critical to understand the risks of leverage. 71% of retail accounts lose money trading contracts for difference with this provider. CFDs are complex instruments, and leverage can result in rapid financial loss. Practicing this strategy on a free demo account is the only responsible way to build competence before risking capital in a live conflict scenario.